So the question is, will it be different this time? And I like to look at this chart because it shows how many times we've stood at this precipice. Since 1980, the government has raised the debt ceiling 78 times. So 78 times this has been a political game or a political discussion. 60% of the time, the debt ceiling was just suspended until both parties could come to an agreement. And I think that's one of the most likely outcomes. Either we're going to see the debt ceiling get increased or be suspended for a period of time until both sides can come to an agreement. The government does have some other options you may have heard of. They're a little more extreme, like minting $1 trillion coin. But I think those other options are very unlikely to happen. If no one crosses the aisle to help kind of make something happen, we could see some market volatility in the summer. If House Democrats are kind of able to pick off some Republicans to pass a debt limit increase, then we could all move on. Could this be different this time and maybe it look more like 2011? I mean, that's a possibility. That's what some people are afraid of. But making sure you have cash set aside for any withdrawals you may need this year, having a properly diversified portfolio, those are really the best ways to counteract that kind of short-term volatility that could be caused by a political standoff. It really isn't in the country's best interest to push this to the absolute brink because that's what caused the Treasury debt downgrade back in 2011. So if this gets pushed past that X date this summer, there needs to be potentially more spending cuts. I think there could be another discussion of downgrade, but I don't think the politicians will let it get to that point. Or they'll suspend the debt ceiling at that point in time to kind of buy some more time. If we did get another debt downgrade, that could mean higher interest rates that the government would have to pay. Nobody wants that on their watch. They're going up as it is already, and receiving a downgrade means you'd have to pay even more interest. And that could have some really bad long-term impact to the debt that the country has. And higher interest payments, they can become a much higher portion of GDP, and that's kind of something I think everyone wants to avoid. So right now the markets are actually bracing for this. If you look at the credit default swap market, they're pricing in that this could get pushed to the precipice and we could receive a downgrade. In 2011, when that happened, markets dropped here in the US about 15%, and internationally they dropped about 30%. However, once the debt ceiling was increased and things were able to go back to normal, markets recovered very quickly within a couple of months, and we're right back to where they started. And you might think that treasuries would perform poorly during that time period, but they actually rallied through that downgrade because they're still kind of the best in a bad neighborhood. So they still receive that kind of flight to quality trade, which is kind of counterintuitive if you think of it, but that's what actually happened back then.